investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And one of the things that pops out right away for me on this particular chart is the candle pattern from Friday, March 20th. And you can see that there is a long shadow on top of the candle, which is actually on slightly lower volume from what we saw on Thursday. Now remember, on Wednesday we had a bullish engulfing pattern. The market went up. Today again it went up on the 20th, but we're reaching an area of resistance right here up around the highs from March 2nd. And the interesting thing is, if I look at the intraday chart from today, Friday the 20th, you'll see that towards the end of the day we had a dramatic sell-off just about in the last hour of trading. Now, a lot of times we see that as traders get out of their positions. This could have been where they took a long position early in the morning, but they didn't like the way the news was shaping up towards the end of the day, so they decided to take their profits and sell out of those positions. You can see that we did have a gap up in the morning from the intraday chart. This is a minute by minute chart. So I think we could actually next week come all the way back down to where we started this morning, and we could see a lower downturn in the market as we approach this resistance high. So what I'm going to do is draw a forecast. I'll draw just a minor trend line in what I think the angle could look like, and I'll drop it right there. Now also keep in mind that there's a series of gaps below the market that are going to act as magnets. There's a gap right there. There's a very slight gap down here right around 168. There's another gap down here right around 164. And there's another very slight gap all the way down here right around 162. If I zoom in, it's a little bit easier to see, obviously, but these gaps right here are going to draw the price down because 80% of gaps fill, and when you have a sequence or succession of gaps, just like we see here, that makes that magnet that much stronger. So I am going to continue to remain bearish on the market, and I know a lot of people are feeling that this bull market is not going to end, but what's happening is that the economy is not growing as quickly as the market is suggesting. In other words, the Dow Jones historically has led the economy by about 9 months, 6 to 9 months to be exact. And our economy is not going up in the same direction that the diamonds have been going up over the past years. So again, looking at the weekly chart, you can see that we've been in an upward trend, but the economy has not been following this. So what that means is the Dow is diverging away from a stagnant economy. And that's why I continue to remain bearish and wave the caution flag whenever I get a chance. Eventually, when this market drops, it could be a significant drop. And I'm trying to get everyone to prepare so that they're not caught in long positions at the top. If we look at the spiders, the ticker symbol SPY, you'll see the same thing in that we have a resistance high right here, right around 212, and we have gaps down below the market. So what I'm going to do here is I'm going to draw a forecast and what I think that angle could look like, and I'm going to hold that until we see how this plays out. There's a good chance that the spiders are going to pull away from that resistance and start turning lower. We look at the Qs. This is the NASDAQ market, also known as the power shares. You can see, same thing. It's a duplication of what we've had throughout the rest of the markets. Resistance, we have falling volume, we have gaps below the market, and if you look at today's candle, we have an inverted hammer. It's a long shadow above this small-bodied candle, so the forecast for the Qs could very well look just like that before we hit some sort of support down here right around 105. So I'll do my best to leave those lines up, and we'll take a look at those on Monday when we have the open house. I'll talk a little bit about that in a moment. Finally, looking at the VIX. This is the CBOE Market Volatility Index for the S&P, and it's inversely related to the S&P. And what you see here is a hammer pattern. A hammer pattern is a bullish sign. So I think the VIX is going to start to move up to at least test this resistance back here right around the $17 level. But remember, if the VIX starts moving up, that is bearish for the S&P. So the S&P could very well start moving lower. If you go to the Market Guys website, right there on the front page, we have a registration link. You just have to scroll down a little bit. It's a registration link that'll bring us to the open house Q&A session that we're having March 23rd at 8 p.m. All you have to do is click on that link, and it will open up to a template that allows you to put in just some basic information. So all you have to really do is put your name and your state that you're from. You don't have to put your email address in. That's not a required field. Just your name really and the city will work for you. And then what we can do is we'll take your questions and we'll answer those questions along with analyzing your stocks so that you can get a better idea of what your positions are looking like in this overextended market. So that's it for this week's market report. Have a great weekend, and we'll speak with you on Monday. So long.